You are listening to Keystone Stock Talk Podcast, episode 140. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We have a busy show for you this week. In our case for, case against debate, we take a look at unknown high growth small cap Apollo Healthcare Corp, symbol AHC on the TSX. Apollo is one of the largest private label personal care product manufacturers, which saw its sales and profitability skyrocket in 2020 as one of the third largest producers of hand sanitizer and private label cleaning products sold at most of the big box retailers, including Costco. Aaron argues the bear case, Uncle Brennan is on the bull case, and I sit in as judge, jury, and executioner. In our Your Stock Our Take segment, we answer a listener question on Gran Colombia Gold Corp, symbol GCM on the TSX. The company is engaged in the acquisition, exploration, development, and operation of gold and silver properties, primarily in Colombia. We let you know whether it provides value at its current price. So let's get into the show quickly. How you two doing? We did our big seminar on the 6th last week. How are you feeling after that, Aaron?
Big seminar last week, and then we have the second part 2 tomorrow. So that's
April 13th, 7 p.m. Eastern, right?
Yep.
7 p.m. Eastern, 4 p.m. Pacific.
Yeah. So I think those tickets are selling out. So anybody who wants to be a part of that should sign up. But I thought that the DIY went off great. I mean, it was record numbers in terms of attendees, which doesn't really surprise me considering everything that's going on in the market. People want to get that advice and want to get that perspective, and also a couple of great opportunities that they can add to their portfolio. So certainly not a surprise, but I think we did run out of time. I don't know how many more questions were left at the end, but we had pretty much a full 45-minute Q&A, and we still ran out of time. So of course we invited the attendees to pose their questions after the seminar and got back to everybody.
Yeah, for sure. I mean, it's unbelievable. For we did more people in that one room, one session than we used to do. We used to do these in person across Canada. We'd go to 9 cities. So we did more people in that 1 3-hour webinar than we do in 9 cities across Canada. These webinars are building every time we have them. We're adding 30, 40, 50% more people in the room. It's great to see. I think the content was good. And we had new recommendations there, 6 or 7, not new to our clients, but new to these seminars. We went through companies. I can tease them right now. This is what we do. An unknown healthcare tech stock, which saw earnings jump over 400% in Q1, trades at around $1.50. We detailed that company. Our top Canadian REIT right now, it trades at a significant discount to peers. Number 3, our top gold-related company. It's poised to grow revenues 47% and more than double cash flow, but it only trades at 5 times cash flow. So we also introduced number 4, Canada, our first ever Canadian-based cannabis buy, which is profitable and trades at approximately 1 time sales. Number 5 company here would be our top U.S. infrastructure stock, which is really positioned well to benefit from Biden's $2 trillion plus in infrastructure spend. Number 6 would be our top SaaS cloud computing company. And there's one more bonus company that we added in there. Some really diverse companies that we talk about here. Great topics that we get into. Like Aaron said, we literally had a full room, so we had to cut off right at the end our ticket selling. So if you want tickets, this is the last spring webinar we're doing. It's coming up tomorrow on the 13th. So get in there. Anything to add on that, Brennan?
I guess nothing too elaborate, but I guess one thing that I could touch on is just that we are coming out with our Canadian cannabis report here, shortly. And I've been running the numbers on a lot of these cannabis companies, and just, it's crazy some of the valuations out there for some of these large Canadian cannabis companies that are, losing $500 million and are trading at like 8 times sales. It's just crazy, So when we look at our first Canadian cannabis recommendation in the space, I personally believe there's some value there. So,
one-time sales and profitability.
Exactly.
Not much in the sector is trading at that. You can find these little anomalies, right? And that's what we'd love to do. Find those little anomalies that, it's not that little. I think the company had 51 million in revenue last year. So those are businesses
we're looking at. But it was surprisingly unknown, to be honest.
Yeah.
I mean, there was more attention being given to the companies that were, the companies like Canopy, like Afria, a few others that were generating a lot of revenue, but were so far from profitability and so speculative in our view. And then here's this company that's actually right from the beginning producing profitability and focusing on that as a key part of their strategy, which is what we love. And people weren't really talking about that until they were, right? Until, several quarters later when...
And you're talking Trulieve now, right?
Yes, I am talking now.
Yes. Yeah, good. Yeah, I mean, this is a company we recommended this time last year. Wasn't sure if we were
naming names or not, but yes, that is the company that I'm talking about.
Yeah, no, well, I mean, we've talked about Trulieve on the podcast.
And the company is
before,
up, several 100% since our recommendation.
Yeah,
since we had it in our cannabis 2020 cannabis report in about a little over a year ago. So.
Yeah, I mean, it was trading between $11 and $15 there, and it shot up to $50.
But it led the way,
literally,
didn't it? Like when cannabis companies started to recover, I noticed that it was actually because they were out of favor really when we recommended them. People had realized that there's a lot of supply demand imbalance in Canada. The stock prices had come down a lot. That's when we saw an opportunity. We made our first recommendation, and it started to perform ahead of the sector. I found it really kind of led the sector, right? And that's what we're always looking to do.
And focusing on the profitability, and that was our top pick after looking at, we liked the U.S. market last year. We still like it going forward. That was our top pick in this sector at, this time last year, going into to 2020. And, we still like that company long term. We still like a couple smaller names in the U.S. market as well. And now we have a company that we're looking at that is focused in the Canadian market, that again is vertically integrated as Trulieve is, but it's in the Canadian market, focused on, from seed to sale. And we've seen that model successfully used in the U.S. market. It may be successful in the Canadian market, and that's why we're looking at that company. It's certainly buying it at a reasonable price right now. That's what we're looking for.
Yeah.
So one thing we touch on too in the seminar is I talk about the concept of the new normal. On this topic, I will start with Twitter. Now, I find Twitter half the time, especially Fin Twitter or most Twitter, as a cesspool, really. But I peruse it from time to time to amuse myself. And once in a while, my eyes are open to some new ideas. What I've been seeing too often, particularly over the past year, is increasing talk about how stock valuations don't matter. Or we need to completely change the way we look at value in companies, use new valuation methods, often things that are hard to measure, such as how a business may rank on the disruptive meter. So essentially it boils down to the old argument that are we in or creating a new normal? For me, this is always scary. Well, I heard the same arguments back in the .com bubble when a ton of traders came into the market, or when oil blew past $200 a barrel. You heard this is the new normal. Or at the outset of the cannabis boom, when a ton of people lost a ton of money betting in some fly-by-night cannabis companies, it was the new normal. You had to be invested in this. Each time we've heard it's the new normal, it has not been over the long term, and we must be cognizant of this. Now, I'm going to give you a quick example of how quasi-analysts on Twitter are bringing about what they think is the new normal. Now, this is by no means the biggest culprit. There are by far more egregious examples of this, but I'm going to look at a tweet here. Now, you can't really see it because we're on a podcast, but I'm going to tell you what it says. The author says, and I'm not really pounding on this author, but I'm just going to tell you what is said here. I bought a new stock this week. I think it has 10 bagger plus potential, meaning going up 10 times from where it is now. So it says, here are the check marks: 3+ revenue streams, check. Disruptive technology, check. Founders involved, check. High gross margins, check. Massive total addressable market, check. Optionality, check. And then this is the kicker for me. It says, and it's only trading for 10 times sales. Are you curious? And then he gets into it, right? So, I mean, for me, like only 10 times sales is a high multiple, unless this is just a tremendous business. And even then, everything has to succeed over the long term. You have to look into the business. So I looked into, this business that he was talking about. So I was expecting to find, a tremendous, say, SaaS business or a tremendous high growth business that's increasing free cash flow on a quarterly basis, something like that, to pay 10 times sales going forward. So I look at this business and I look what it did in 2020, 13 million in revenues, up from 11.3. Well, total loss was 12 million, up from a loss of 10 million in the same year. So the business is growing revenues at 12 to 15%. To me, it just doesn't. It does not hit me in the face like this is a tremendous opportunity. In this case, the company remains speculative without ever producing cash flow and without profitability. There is a lot of speculation in this proof of concept. It really hasn't proved out the concept here. Now, the words disruptive technology for me get thrown around far too much. Whether a technology will disrupt or be the next standard in an industry is very, very difficult to predict. Even for specialists who are immersed in the industry. For financial analysts to consistently throw this term around as a valuation method, it seems often silly to me. The cash flow doesn't lie. This business has zero cash flow. We prefer to use it as our guide rather than guessing on potential disruption. True disruption is very rare. If you hold, say, 15 to 25 stocks in your portfolio that trade at high valuations, like this company, say 10 to 20 times sales, or with no sales, as we see many businesses, but they promise disruption, you're taking too much risk. The process you are taking has too much undue risk in it. We prefer to create a portfolio of 15 to 25 stocks with a certain profile. And this profile is good, solid cash flow, good, solid revenues, good solid growth looking forward, a good balance sheet, and they trade at relatively reasonable valuations. The more stocks you add like this, of the 20 to 25 you have in your portfolio, the better chance of success you will have in the long term. The more you structure your portfolio with bets on some technology that you think is disruptive, and you have 15 to 25 of those, good luck with your portfolio over the long term. We believe value still matters. Price is what you pay. Value is what you get. It doesn't have to be the cheapest stock out there, but it has to have some sort of fundamental value for us to add it to any portfolio. And I think it's a cautionary tale when we look at these companies, 10 to 20 times sales. Wow, disruptive technology. But, we don't know whether it is going to be the technology that wins out. And even when it is the best technology, it always win out.
And only
any thoughts on that, guys?
It only has again, what is it? 12 trillion month over 12 trillion month revenue growth, 12%, did you say? Or
yeah, if 13? It's 15 in that range. Yeah.
So
12 to 15.
Realistically, looking at a company with, that's trading at a 10 times price to sales, what do you think, how much revenue growth should that company actually have before we're like, oh, this is interesting? Do you think 200% revenue growth year over year, something like that, essentially? Do you think that would be more in line?
Almost at least 50%. Mm-hmm. You'd have, or unless they had some SaaS business that was recurring and it was 30% plus, and then you could see them investing in the technology, and then and potentially that's decreasing their cash flow right now, but going forward, you could see the business being more profitable and cash flow adding, 2 to 3 years down the road, significantly cash flow positive. It's a really small business at 13 million in revenue right now, and saying it's the words cheap in this tweet are in capitals. Cheap at only in capitals, 10 times sales. We still find businesses with growth of 40% trading at 10 times earnings, right? even in this market, you can still find that. And you don't always want to buy the cheapest company out there, but it's not cheap with 13 million in sales, trading at 10 times sales, growing at 12 to 15%.
And again, that Canadian cannabis company that we're recommending, I believe, again, around 1-time sales, and they grew revenue at around 60% last year, I believe, year over year. So,
in that range.
Just to put it into perspective for listeners.
Yeah.
Well, one thing that you really have to consider
Yeah.
At this stage of the market here is that there are a lot of people who have been in the market now for over 10 years and have never seen a downturn. They don't know what a downturn looks like. And anybody who's been in the market for, 2 to 5 years has seen some pretty, a little bit of volatility at times, but it's some pretty stellar performance. And it's almost like a situation you get at certain points in the market where you can be completely incompetent when it comes to selecting investments and still make money, because it's easy to get lucky when the market is going up. It's not that hard to get lucky. It's not impressive to get a good return when the market is raging up, especially if you're speculating. There's going to be some people who speculate in a strong market and don't do well. And some that do especially well. But it's always the ones that do especially well that you're going to hear about. They're going to be the ones that are on the financial news. They're going to be the ones that are on YouTube, the ones that are on Twitter. But when you start to get into this mentality, and it's a mentality of overconfidence, really is what it comes down to. You have financial professionals, people who have been in the market now for years, believe that they're experienced. Even people that have more experience but don't remember what it was like before the raging bull market, they start to get overconfident, and then they start to take unnecessary risks. They start to be subject to things like the fear of missing out, and this is what essentially creates bubbles. And I'm not trying to predict where exactly we are in the market, or if a bubble is going to pop, or even if a bubble exists right now. I think bubbles do exist in certain areas of the market, absolutely. I don't think that I know it, but when they're going to pop is not something that can be known. And I also think that certain segments of the market are actually not that overvalued. And in some cases, there are certain segments of the market that are actually performing very well. They may be trading at high valuations, but they deserve those valuations. But to just look at the last couple of years and trying to extrapolate that going forward is one of the most dangerous things you can do as an investor. And it's really what eventually leads to market bubbles and downturns.
Can I, on this whole topic of expectations, Twitter, and all this, can I read you guys one tweet that I earmarked just this past week?
Yes.
Now this, and then we'll get to going through Apollo Healthcare Corp and our Gran Colombia. But says here, not gonna lie, I set out to make $1 million in 2021 on the in OTC, which I'm assuming means trading OTC or over-the-counter stocks in the US. Started with $350K in mid-January and have only $110K left. I've been in tears every day and experienced every horrible emotion imagine. I'm glad I didn't make $1 million overnight. I am humbled and ready to grind.
By grind, I would hope that person means go back to the very basics and actually learn how to invest. Because the first major mistake that this person made is expecting to triple their $300,000 in a year.
It just
right,
the mindset is mind-boggling.
I'm not saying that you can't. Yeah. Like some people can invest in speculative things, and they can. You can triple your money or better. But to go in, there's a certain element of luck. If you're getting that type of a return, there's a certain element of luck. Even if you are investing in good companies and making really good decisions. But to go in with an expectation of tripling your money in 1 year, of course you're setting yourself up to fail, right? But this goes back to my other comments about overconfidence and fear of missing out. These people are seeing other people that have invested in Tesla, that have made tons of money doing trading on, through Wall Street bets. I heard that one of the main influencers on Wall Street bets is now a billionaire, making money from Bitcoin, making money from non-fungible tokens. And it just basically looks like it's easy. But what you have to remember, once again, is that there's that survivorship bias, and it's always the people that make the most money and do the best, typically, that you hear about. And usually the tweets like you just read just kind of, they fall into the background.
the continue on, the replies to that tweet are shocking because there was hundreds of stories of the same type of thing. Individual investors, like this woman lost $240,000 since the start of this year. Since the start, like we're talking about literally a couple months, right? So she had 350, she's down to 110. Gaining that back will be absolutely monumental, and the risk you'd have to take on, she'll probably go closer to zero than get anything back.
Yeah, the whole idea of gaining that back it would be another mistake.
It's not going to happen.
You need to just forget about the money that was lost and not worry about this imaginary $300,000, which was real in the past but is no longer real. Now you have 100 and change, and that's your portfolio, and you just need to move forward with that and not target like, I have to get back on top by the end of the year. That's how gamblers think. Yeah, they'll be this person would be down to zero if that's a strategy.
Yeah, but I'm seeing a ton of those type of tweets out there, and it really makes me understand. It makes me want to bring our message out there of building quality businesses, 15 to 25 quality stocks, put those in your portfolio, set realistic expectations, but you can get outstretched returns, over the long term if you build your portfolio that way. And that's what we continue to preach. And what we would not want you to do is put your, money in these higher risk companies, maybe promising you the world, but you can get the returns that you're looking for with a company like Expel or Boyd, the most boring businesses out there that have been the best performing stocks over the long term. And that's what we're trying to put in our clients' portfolios over the long term. So let's get to this debate. Apollo Healthcare, certainly a tremendous year in terms of revenues and earnings for this company. Trades at about $4.29 in the market. Market cap $315 million, in that range. They are one of the largest private label personal care product manufacturers. Again, it saw its sales and profitability skyrocket in 2020 as one of the third largest producers of hand sanitizer and private label cleaning products, sold at most of the big box retailers, including Costco. So the case for Brennan has that. Are you ready?
Yes. Are you going to count me in?
I can count you in. Do you need time to take a big breath, or
Yeah. I'll be right back, actually.
Yeah. Okay.
Just kidding. No, I'm ready to go.
All right, Uncle, make your niece proud. 5, 4, 3, 2, 1, go.
Number one, great growth in revenue with 92% growth in fiscal 2020 compared to fiscal 2019. And although sales were accelerated by the COVID-19 pandemic for its hand sanitizer products, I believe hand sanitizer will remain a hot product for the next 1 to 2 years. Number two, the company has a healthy balance sheet with a cash balance of $31 million and zero debt on its balance sheet. The company is well positioned for future growth. And this time last year, the company actually had over $60 million in debt, which was all paid down from cash flow. Number three, trading at just 3.3 times EV to EBITDA, or with a price to sales multiple of under 1 times. Even if growth does begin to decelerate, Apollo offers growth at a reasonable price going forward. And number four, on top of this, Apollo is working on growth opportunities, in which the company was granted an R&D license by Health Canada in late 2019 to begin developing cosmetics containing CBD. If the company is able to release topical CBD products, this could further support growth into the future. Boom.
All right. Right on time. Nicely done. Aaron Dunn. Speaking of done, Aaron Dunn. Are you ready?
I'm ready.
You're ready? Okay, I'll count you in. 4, 3, 2, 1, go.
I'm not going to argue past financial performance. The numbers in 2020 were great, but that performance was already reflected in the share price in 2020. What matters to the future stock return is how the financial performance trends from here. And unfortunately, the company is providing the bare minimum of disclosure, which makes it impossible to know if profitability and growth are sustainable in 2021 and 2022. I looked at the website, through the financials, the disclosure docs. There's almost no information provided by the company, nothing resembling an outlook. All they said was that growth was from higher volume of products sold. But what products? I can see about a dozen of them, one of which is hand sanitizer. My concern is that this is a short-term blip due to COVID. The company wasn't even making money pre-COVID and traded at pennies. The stock could easily be trading at pennies again once COVID demand begins to subside or more competition comes in. Past financial performance doesn't drive the stock price going forward, and if growth prospects are so great, then why isn't management communicating this growth strategy to the market?
And you got 2 seconds left. Good job. Nice.
Good job,
it is
Aaron.
a tough one on this one.
Yeah, this is a
Anybody
fun
want to
debate.
add anything in the end?
Well, no, I just think that we both made good points. And yeah, like this is a really good debate here. I really don't know which way it could go. Cause I mean, yeah, I don't know. I guess you're up, Ryan, realistically.
Yeah, no, I think it's a great debate. This is your classic case of, I mean, there is is it a value trap, right? There is tremendous value based on the last year. And as we know, and it'll probably have a record quarter in the first, over the first 3 months of this year as well. Then it faces the Q2 period, I think, for them, which they had tremendous bump from the COVID-related sales. And Q3 will be like that as well and going on. So does it face declining sales over the course of this year? It would be great to get management's assessment on that, get some guidance. They have not really offered that. Now, we have interviewed management. They were forthright in the interview, but they don't provide any guidance. So, we like the underlying fundamentals of the business right now. And this was highlighted in our Cash Rich report as a company that has potential. If they can start to go out there now and some of the relationships that they've created during COVID, where they serve the needs of some of those big box retailers with the hand sanitizer and the cleaning products, if they can start to go out there and further those relationships to bring on other products. And do we see, I hate using this word, do we see a new normal? Now, is that new normal in terms of hand sanitizer a 10% lift over what we saw pre-pandemic? Is it a 25%? Is it a 50% lift? I don't know that going forward, and management hasn't provided any guidance on that as well. They would help the market if they went out and thought what the more normalized level of sales in this key area for the company are going forward. So yes, based on the current fundamentals, based on the fact that they've generated a ton of cash, Apollo looks like a good buy right now. But as Aaron said, the business or the stock price is not determined just on the past, it's determined on the future. As we have no sight lines to the future growth of the business, as we have no guidance from management in that regard, it's hard for us, for our large client base, to tell them to buy right now. If a client wanted to take a speculative position and think there is a new normal, it may be a bet you could make. But given the fact that we don't have that guidance from management going forward, and we do believe there is a huge bump from COVID-related sales, on a go-forward basis, we just don't have the confidence that this company can continue to drive revenues at the scale that it did last year. So at this point, we would just be on the sidelines and not be buying a position. So I'm going to go on the side of Aaron on this one. That's a long-winded answer. Yeah.
Wow.
Well, I'll just a little bit of background here. I did give Brennan his choice, what side he wanted to take, and when I first started looking at the company, I thought that I did have my work cut out for me. But then when I actually tried to get some type of a comment from management, I realized this was actually. I was pretty confident this was going to be an easy win. Yeah.
The thing is, I could make a case, like we just talked about there. I can make a case for owning this business right now. Like we could make a really good case for owning the business in terms of the growth, in terms of the revenues, and the fact that the valuations are so low. And the other thing that's the wild card here is they're generating a ton of cash by we think midway through this year, they're going to have a huge war chest of cash in the bank. They could go out, buy another business. They could bring other products into the fold. All of these things could happen. If those things happen, then we're looking at a whole different business and, a whole different case to be buying it. But, that communication hasn't happened from management, and they've been not good at doing that so far. So we'd like to see them get out there and provide more communication.
To me, there's no excuse, right? Because I've seen companies that don't like to spend much time communicating with the market. They don't have much on their website. They don't put out presentations. They don't do conference calls. They sometimes won't even take calls. But you'll still see a quote from the CEO or the president in the press release, or you'll still see some type of color in the MD&A, some type of a breakdown of where the growth of the sales are coming from, you literally see nothing from this company. I mean, I went through the MD&A, I went through the website. They literally provide no information beyond just the historical financial results. And there's just not really much we can do with that. Right?
I agree 100%. Again, we're on that topic of management just not talking to the market about what they're doing, where they're going. Like even the CBD products, I put that into my case, but realistically, I have no idea. They haven't put any color on that since Health Canada gave them that R&D license. So realistically, again, management hasn't said anything. As well, something that I learned. So I'll just to tell my personal case with this, and this is the reason that I took the for side, is I guess a few months ago, I ended up purchasing the warrants of Apollo Health and made a decent return. But then the warrants pulled back a bit. I bought more, and I ended up, losing some money on my overall investment. So I learned a good lesson in the market. And what I learned by losing some money in Apollo was that sentiment is so important to investing. As a lot of people understand that, like Aaron said, going forward, we don't know if hand sanitizer is going to continue to sell like it has over the past year for Apollo. So, that sentiment going forward, there's not too much positive sentiment, which is kind of leaving this dark cloud over top of the stock, which is, what forced me to sell out as a loss. But, although I took a loss in the market, I did take a valuable lesson away. So, I mean, I do just want to say that or point that out.
Yeah, I mean,
Did you turn 300,000 into 100,000?
No.
We're just talking about. Okay.
No, the company has and we looked at it. We originally looked at it mid-pandemic, and I think the management missed an opportunity to really go out there and communicate this story. When there were some companies that had loose association with higher sales during a pandemic, or the promise of higher sales during the pandemic, and their share prices just took off. Apollo probably had a chance to have its share price really take off if they communicated that they were one of the largest sellers and only one of the only public companies in Canada that had exposure to hand sanitizer. You could have then gone out there, got a far higher multiple, could have made an acquisition, those things that you could have done. They just really I like companies that put their head down and do the work, but you also should talk to the market if you're going to be public.
You're a public company. You need to communicate the story. Yeah.
They missed an opportunity. There's always the opportunity to start communicating right now. Say what we plan to do with all this gobs of cash that we're earning. But unless the market knows that, you're just guessing. And right now the market is guessing, and that's why it's trading at such low valuations. So let's now look at Gran Colombia Gold Corp. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. GCM on the TSX. Question came in from a listener over the past week. Currently priced at $551, $337 million market cap. They just are completing an acquisition that likely goes up. But what does the company do? They are engaged in the acquisition, exploration, development, and operation of gold and silver properties, primarily in Colombia. So look at some key points here. 2020, the annual production was down 9% to 220,000 ounces, compared with 239,000 ounces in 2019. The total produced in Q4 was down to 57,000 ounces from 65 in the same period last year. So the guidance for the coming year, they expect to produce between 200,000 and 220,000 ounces of gold. The guidance of the production there is to be down around between 9% to flat to what they did last year. Revenues, however, in the quarter, Q4, were up 13% to $99.7 million. That reflected, because production was down, that came because of the price of gold increased. Average in the quarter was $1,875 per ounce sold, whereas last year it was about $1,480 per ounce sold in Q4 of 2019. Adjusted EBITDA was up 6% to $43 million. On an EV to EBITDA basis, it looks undervalued. It has a relatively good balance sheet. They're spending some of that capital to purchase a company. We'll talk about that in a sec. It's roughly $140 million in debt. Now, if we look at what, we see good growth in revenues over the past, from 2017 when it did 215 million in revenues up to a trailing 12 months, or up till 2020, it did 390 million. So good growth there, and good growth in profitability. Now, the company on March 15th announced of this year that it entered into a definitive agreement to purchase all the outstanding shares of a company called GoldX, which owns the Toroparu something project in Western Guinea, the gold district. Total consideration paid $315 million. They believe, Gran Colombia, that the combined company will consist of a complementary asset portfolio, including world-class free cash flow generating operations in Colombia, its current operations, as well as a large, high-growth, de-risked project in Guyana, that project that I couldn't pronounce there. And it boasts 4.5 million ounces of long-term gold production over a 24-year mine life that they're estimating. Now, in the end, any investment in a gold producer is highly correlated to the price of gold itself. If gold increases in value this year, which it has not year-to-date, gold-related stocks, such as Gran Colombia included, will perform well, likely. The opposite is also true. Now, Gran Colombia is interesting and valuations may look attractive, but given the track record here, what we're looking at is a near-term production drop-off. We saw a production drop-off last year, a production drop-off likely again this year. There is the potential of bringing this new gold-producing asset into the fold, but there's always a lot of risk that can go on bringing a new asset. We see better ways to be exposed to gold in the near term. We'll continue to monitor it because it looks at low valuations, looks to be trading at, but right now we see better ways to be exposed to gold in the long term.
It's a risky proposition, investing in mining, gold mining. I'm not saying don't do it. I think that from the sounds of it, there's some fundamentals there maybe, but I believe that I've looked at Gran Colombian several times in the past, and if it is the company that I'm thinking of, then there certainly could be an argument for it. But it's especially, some of these smaller, less diversified miners, you really have to know the properties well. You have to understand mining. It's a very specialized field. For us, it's not. I mean, in select cases, we recommend mining companies, but for the most part, it's not an area of the market that we like to gravitate to.
No, and it's just going to mainly, you can have a company do tremendously well. Like the results in terms of revenues and earnings for Gran Colombia were pretty good this year, but year to date, the price of gold has gone down. This company started the year at $8.24 and it's at $5.55 right now. So significant decline in the share price, and likely all because of the fact that gold has gone down. So the management may be executing very well. This acquisition may work out well for them in the long term. In the near term for them, the price of gold has not moved well for them, and the stock has got significantly hit. I mean, this is what you have that commodity risk.
Gold has been actually quite disappointing. I would have figured with all of the inflation in financial assets and other stores of value. I mean, we've seen stock prices go up, real estate prices go up, other metal prices go up. We've seen, Bitcoin, obviously, new types of crypto assets like NFTs, even like collectibles like baseball cards and art have gone up. Virtually anything that's considered.
Non-fungible tokens, art, all these things. And gold starts the year at 1944, right? Yeah. 1944 US. Is at 1,732
and that worries me. Is it losing its psychological perception then
store
as a store of value,
yeah.
right? Because a lot of young people, I think, don't really see the attraction of gold, right? They'd rather put the money in Bitcoin, and by young, I'm meaning anybody under 40, basically. Whereas gold bugs, they tend
anybody under 60 is young. Aaron, come on.
Yes.
The older you get, they just keep pushing that out. Anyone under 90 at some point is young. I'm going to start saying.
My grandma actually turned 90 today. Yeah, it's her birthday.
She's young.
Happy birthday, Grandma.
95.
You're young.
Anything.
No, but she is.
Happy birthday to your grandma.
Happy birthday.
Is your grandma a gold bug?
No,
she might be.
She's not a gold bug.
Yeah.
No.
So it's concerning. Anyways, it's concerning to me that I would have figured in this type of an environment with so much expansion of the money supply, you would see the gold price shoot up as well. But no. So that would be a concern.
for sure.
Without a doubt.
Now, some might say that means that gold is undervalued and that it's going to go up. Others will say that means that gold is losing its status, or there's other stores of value that are competing investors away. But regardless, it's been, I would say, very disappointing.
No, I agree. And we'll continue to monitor gold and a number of things. We'll talk about it as investment in our upcoming seminars. Just really focusing on good quality companies, helping you build that simple 15 to 25 stock portfolio. Tomorrow is the last chance for you to get a ticket to our, April 13th seminar. We encourage you to get those. It's been great, and we look forward to answering your questions in that webinar. That's going to close out our show for this week. Continue to rate and review us on iTunes or anywhere you get this podcast. Keep your questions coming into our Ask Us Anything segments, our Your Stock, Our Take, and our Case For, Case Against, and we'll continue to answer those on a weekly basis. Thank you very much, and I wish you all profitable investing.
Profitable investing.
Thanks, everyone.